Good afternoon. We appreciate everyone joining us. This is the advisory angle from the Chrisman commentary. I'm Garth Graham from Stratmor Group. I'm going to introduce a couple pretty special people, including the granddaddy of them all, Rob Chrisman, for which this is Chrisman commentary is named on. That's you, buddy. By the way, for those
Garth, I got to interrupt.
Yeah,
I'm in a feisty mood. First of all,
go for it.
you've already exhibited your East Coast centric, thinking. It's morning out here on the West Coast, so
Exactly.
you can
Well,
say
that's
good
true.
afternoon, but for a good chunk of the viewers, it's probably good morning. So,
Exactly. Well, and then for those of us watching it on YouTube later, because this is just streamed worldwide. God knows it could be morning, evening, afternoon. Hell, it could be tomorrow by the time somebody watches this. But
yeah,
the one thing I want to do really quick though is this is our first advisory angle of the new year, and Sue Woodard was not able to join us. She's normally your a hostess. And for those of you who tuned in to see her, I apologize because you're not getting
you're the hostess with the mostest today.
you're not going to get the Sue energy vibe. You're going to get me. So, but because it's New Year's, I figured, you know, we had to go semi-formal.
Is that a
So,
t-shirt?
yeah, that's a t-shirt. I could take
That's
the whole
awesome.
shirt. I could take the whole shirt off if you like.
You look like the Monopoly guy. All you
Yeah.
need is a top hat.
Yeah, well, and part of that is because we're celebrating what an amazing year we had in mortgage banking in 2024. So the best we're going to get is a tuxedo T-shirt because it's not exactly was a formal tuxedo power year, but we're going to talk about that. So first of all, obviously, Mr. Chrisman is here, Rob Chrisman, saying hello, as he's already pointed out from his West Coast location.
And
And then we,
Garth,
uh,
I'm sorry, we'll get to David in a second here. Garth, do you own a tuxedo?
yeah, but not one that fits.
Okay.
Uh,
Taking up
but
valuable closet space there in Florida.
yeah, exactly. But in South Florida, I think the real key thing is that you have a tuxedo T-shirt because we like to party. So we
And
also
is
have
the tuxedo white or black?
it's black. I'm
Okay.
classic, Rob. Come on, man.
Okay. All right. Go ahead.
No problem. And then we also have David Hrobon, who's also with Stratmor. And I like to famously tell the story. David ran a mortgage company for Wintrust, so a bank-owned mortgage company for 25 years. Decided to retire and made the fatal flaw of calling me and me saying, David, why don't you just help me out at Stratmor just a little, just part-time, and just until, kind of ease you into retirement. And how many years ago was that, David?
That was 3 years, 4 months, 6 hours, and 7 minutes. But who's counting?
Yeah, look at that. So David does a lot with clients related to helping them manage the mortgage company at scale. And Rob, frankly, you and I have never run a company the size of Mr. Hrobon's experience at Wintrust. So when we start talking about big issues and big scale, we're going to have to rely on David. So we're happy to have him.
Give you
So
what I
But
got.
Garth, you definitely have the advantage of looking at a wide variety of Stratmore clients.
yeah,
And
yeah.
do you think there is a move out there? I hear about it once in a while at the state level. Many states have the Association of Mortgage Professionals. California, CAMP, or
Mhm.
Florida. Whereas other states, they kind of combine everybody, brokers and bankers. Garth, do you think that the environment is different, whether you're a broker or a bank or a banker or a credit union, or are we kind of all in on the same boat?
Well, I would say if you are an originator, you're in a similar boat, which is because your job on the origination side is to engage with the consumer, counsel them on what the best products are, and then ensure that the loan can be effectively processed and ultimately closed. By the way, I started as a loan officer, so 30 some years ago. So I slip back into, what it means on the origination side. I don't think there's a substantial amount of different because that skill set is still so similar. Whether you're a bank-owned independent mortgage banker or a broker, the compensation may be different. Some of, the level of support you might have from the parent entity is different. The entrepreneurial feel of it certainly may be different. But heck, the job is still talk to consumers, listen to what their needs are, engage with them on an empathetic basis, counsel them on what the best option are. And really, the way you're going to get your business is also similar. You're going to have to engage with realtors or other influencers and enable yourself to, get referrals, at least in the purchase market. That's usually what typically the market is. So whatever the association group or session that you attend, normally it's, where do I get value? Where do I learn? Where do I sharpen my skills or education? So from an origination perspective, I think it's pretty similar as to, what that feeling's like. When you get up into maybe the management side is, different regulators, different counterparties, that may be a little bit different. I don't know, David, did you have any thought on that?
Yeah, well, exactly what you just said. From a loan officer's perspective, I think you nailed it. From a managerial perspective, I think there are some definite differences. The level of regulatory oversight, scrutiny at the bank level continues to be pretty onerous. As I like to say, in mortgage banking, you like to be able to measure twice and cut once. Sometimes when the market's moving so fast, you're lucky if you even get to measure once. But in a bank environment, you need to measure 15, 20 times and hopefully cut once, sometimes at a managerial level. That's a real thing. So,
Wow.
Yeah.
Stratmor has arguably one of the top bank. I wouldn't know how to classify him exactly, but Tom Finnegan is like known through the industry as having this solid banking background. And and obviously he uses his skills with Stratmor to help advise banking clients. But
Sure.
the bank environment that's out there is the bank environment. And Garth, I want to ask you, and I don't mean to take over the hostess with the mostest role,
Hey,
but
man.
lately I've been and it'll continue in 2025 spending time with credit unions. Both individual credit unions will have me out to speak or talk to their sales folks, or a credit union organization will have me in to talk. And it seems like whether you're a bank or a credit union or an IMB, and maybe sometime you should have Tom on here, but David can answer as well. It seems like every group of them play to their strengths. And we're here to talk about profit margins or lack of profit margins. And each one has advantages that they try to accentuate in an effort to help their profit margins. Are you seeing that, Garth, at a higher level?
I will say though, credit unions typically don't use the term profit margin. And frankly, they don't normally focus as much on cost and profits at all. It doesn't mean they're not profitable. They focus on member satisfaction, and member household penetration. And I will say, one of the things I always say, whether it's a bank or a credit union, and this is the real sort of shame, is you built a brand and you established a level of trust and relationship with the consumer. And that is normally, that relationship has an element of trust and implied trust. I mean, I trust you with my money. So then it comes time to do the mortgage experience. And they often miss the opportunity to maintain that level of trust because they treat the transaction exactly like any other number of transactions. I'll give you a very good, we do secret shopping at Stratmor, and you'll go to a bank website and you'll play around with it and you'll see, hey, we can do mortgages and we love you. And you click and it goes into, let's say, a point of sale. And the first question on the point of sale sometimes is create a username and password. And you're like, okay, so it's a completely different system. It didn't take my username and password. Then the next question is, okay, what's your name? Well, that's a missed opportunity. The third question is, are you married? And you're like, okay, I have a checking account with you for 20 years. I'm still married to the same woman. She's on the checking account. You don't have to know the intimacy of my experience, but you ought to pre-populate the experience with the information you already know about me. I say this because I think banks and credit unions, if they don't cleanly integrate the experience from the other parts of the business, they break their value proposition in the first few minutes. And then the same thing might happen if the salesperson misses the opportunity. Thank you so much for being a customer with us for 12 years. I see you have XYZ accounts, and we're so happy to be able to help you with your mortgage. Meaning they don't have necessarily the skills to connect empathetically. And a lot of times with these banks and credit unions where they are losing market share or not capturing their households, I think it's literally on a hand-to-hand combat basis. They're not able to continue to engage through technology, people, and process to make the consumer feel kind of valued. The independent mortgage bankers, if they don't do it, they're out of business. So it's like they kind of at least do that, right? When I get an opportunity, I seize that opportunity and I try to convert it. The banks can sometimes miss, I think, the opportunities that are handed to them. I don't know.
Yeah,
now, David, you're the banker, so you got to comment on that one.
Go ahead, David.
Yeah, I was going to say sometimes that disconnect, if you will, is because of a lack of insight, but frequently it is because of regulatory challenges with data security, network security, and making sure that a consumer is not going to be able to create a new transaction in a different loan origination system or a point of sale system that somebody could worm their way back into the bank network. And so there creates this hurdle that you have to have in place that creates real challenges. And it doesn't mean that some people haven't solved it, they have, but it takes time, money, and conviction. So that's what I would offer.
Yeah. And there certainly are, by the way, it's not universal. There's certainly some banks, like you said, that nail it. They leverage a consumer API, they pre-populate an application, they reinforce the value proposition, they thank them for the business. But boy, it's a missed opportunity when they don't. Go ahead, Rob.
And through those opportunities, banks, credit unions can help their profit margins.
100%. Because a bank and credit union is from a profit margin perspective, they are typically starting with a marketing cost per loan that is very low because they already spent it to acquire the customer when they're talking about, existing customer cross-sell. They also generally start at a commission level that is about 30 basis points less. So if you save 20 basis points in marketing and you're saving 30, and this is, I'm saying for kind of the retail model, and the direct model, it's even more acute on the marketing perspective. But if you save 20 in marketing and 30 in commission, you're 50 basis points ahead if you're quoting the same price. And of course, on a bank, your cost of funds is less or zero. You ought to have all sorts of financial advantages if you execute at the same level as a well-run mortgage banker. It just doesn't always turn out that way.
Yeah. I mentioned it in my commentary this morning that the profit margins or companies have spent the last year or two with their noses to the grindstone. I'm going to ask David, I'm going to turn this back to David. David, in your opinion, is 2025 a year where companies, originators can take a breath and coast a little bit? Or is it just going to be another year like 2024?
Well, I would say in my time in the industry, there's never been a year when you could coast. I remember a branch manager that worked for me many years ago. He made the comment, sometimes you eat chicken, sometimes you eat bone. And I sort of asked him, what the heck does that mean? And he was sort of saying, you take what the market gives you. And I always felt like that was a recipe for disaster. And I still feel that way. I think you always have to have your foot on the accelerator, trying to grow into a down market, trying to capitalize and leverage your strengths, mitigate your weaknesses. So I don't think there's ever a time to coast. However, this year, to answer specifically your question, the world, according to David, the small little crystal ball that I have suggests that 2025 could look a lot like 2024. I don't see the MBA's forecast, which right now looks a little aspirational to me. And I think that if I was sitting in that chair today, I would make sure that my team had 3 budgets for this year, not one. One that would be that aspirational 20 to 30% growth in volume, one that would be status quo, and another one that might actually be some retraction and lower volume, and be able to manage to all 3. That would be my answer.
Yeah, I think we're in Groundhog Day. I mean, it's literally like a year later, and I think we're still talking about some of the same issues, challenges, and numbers. And I don't think this Groundhog Day necessarily this year is going to end with meeting the lovely Andy McDowell, nor being able to have the same date with her over and over and over again. You remember that movie?
Sure.
You're like, I mean, I'm like, that didn't seem that bad to me. You know,
I saw that movie for the first time on an airplane a couple months ago.
Oh, that's weird. So this is a really low tech way. Normally we do amazing slides and we project them. I don't think we necessarily have to do it, but here's where interest rates were at the beginning of last year. Oh, dang, it's all blurry. Oh, you see it. See that little red line? Ah, dang it.
Hold it in front of you, Garth.
All right. There you go. There's where it was. There's where it is. It's higher. So we all anticipated that this year we were going to have lower interest rates, and we got them in September, and that refi boom was incredible. It lasted at least 2 to 3 weeks. So we had a 2 to 3
2 to 3 days.
Yeah, well, so we had a little bit of a dip in September, and then it just steadily rose. So even before we have some, major geopolitical changes which are coming in 2025, and we don't want to get caught in, too much speculation on that, we're ending the year kind of where we started, which is that virtually no interest rates and tough inventory, and kind of a challenging market.
Garth, your respect in the industry is well known. Everybody either respects you or is intimidated by you, and they would never interrupt you. Me, on the other hand, I have no respect for you. You don't intimidate me, so I'm going to jump in here and interrupt you, because I think the folks on this event and involved in this event are tuning in to hear you and David and me to some extent, but talk about forget rate projections, forget volume projections. What can we do now?
Yeah.
How can we, we're going to keep our nose to the grindstone, but keep our nose to the grindstone doing what to help our companies? What are you two seeing? Individuals, whether they're CFOs or presidents or originators, or what are you seeing people actually do to help their companies?
So I'll take a crack at a couple. So not obviously, if we're trying to look at margins, what we're really sort of focused on is the revenue and the expense side that you control. And the reason I say that you control is it's very difficult to focus on corporate administrative level type stuff. It's kind of a fixed expense. And I think the point is we're not going to get a volume surge that's going to help us, it appears, overcome some of the base fixed costs that we have in our business. On the revenue side, I think it is absolutely fits a few buckets. Number one is expansion of some level of product. I see a lot more attention paid to non-QM. And non-QM is not, for those of you who don't do it, it doesn't mean subprime. It means certain loan products that generate higher revenue opportunities to meet specific niches. So investors, things of that nature. So I think that expansion of product is part of it. I think the other thing on revenue is to take a good hard look at where you bleed revenue, and where often we see it is in price exceptions and margin management at the branch level, especially with independent mortgage bankers who may give some level of branch margin control to retail. So let's maybe, David, I'll let you answer before we get into the expense side. On the revenue side, there's the product piece, and then there's the management or the bleed part of management.
Yeah, if we get to expenses, there's a list of line items as long as your arm. But in our business, the revenue side has basically 5 components, as everybody on this call probably knows. You know, and one of them is not really a line item in your income statement, but it drives everything, and that's loan volume. And loan volume is driven by recruiting and retention as sort of the highest level. And so continuing to keep laser focused on that, I think is not an aha moment. It's just a reiteration of something that everyone gets. But on fees, I will offer that people generally look at fees, or frequently look at fees, as a gross number. And I would challenge people to look at it as a net number. Where do you have leakage in any of your collected fees? And is there an opportunity to tune up any one of your fees, because an extra $50 or $100 here or there drives straight to the bottom line? And
Or collecting the fee.
Collecting the fee.
Actually collecting the fee.
Yeah, I won't get too anecdotal here, other than to just give a short little example. I was at a peer group roundtable program with Stratmor several years ago, identified that we had a lot of leakage in our appraisal expense, $700,000 on an annual basis, came home, and the team agreed we were going to get out of the collection of appraisal fee business and turn that over directly between the appraiser and the consumer. And we saved $700,000 starting the very next week. And so that's an example of where it's not just, hey, we charge $450 for an appraisal. It's, do we get $450 on every appraisal? Or do we have, you know, multiple inspections or a second appraisal and things like that? So fees, it's not just a gross number, it's a net number. Third one is gain on sale for margin. Same conversation. I put in 275 basis point markup on a conventional loan, but when I close that loan out, do I have 275 basis points there? Was there a price exception? Was there an extension, a free extension? What were all of the leakage items related to that? And then taking it a level lower, what branch, what loan officer is contributing the most to it, and have a coaching opportunity, or worse, but those leakages have real impact in their compounding. Then when I look to warehouse expense, again, we have a unique opportunity at Stratmor. I've seen it for the last 3 years, where we collect a lot of data across the industry. And as much as you would think everyone's warehouse fees, expense, and terms are exactly the same, they're not. And an extra 3 or 4 basis points here or there run straight to the bottom line. And again, you know, as they say, nickels create quarters, or dimes create quarters, create dollars, so on and so forth. And then the last thing that I put on there is other. Are there other revenue sources that you can generate, complements of your customer relationship, that you could get that becomes accretive to you? The most common one is mortgage servicing rights. Other people have agencies with title companies, they AMCs, so on and so forth. There's a host of others that are still able to be done, joint venture programs, et cetera, et cetera. But that's where a lot of people focus on expenses, and I know we're going to do that here in a minute. Yeah. But as I used to say, you have to look at both ends of the snake. It's revenue items and expense items. You've got to address both sides.
David, I need to be writing these down. Both ends of the snake. Nickels become dimes, become dollars, and then there's sometimes you eat chicken and sometimes you eat bone. These are words to live by.
Those are. Yeah, I do think, by the way, the best companies are ones that could measure all of that he just described at an LO level. And you can often will say all the way down to the LO level, well, I don't control margin. It's like, yeah, but on an aggregated basis, if for some reason we keep getting more price exceptions, more lock extensions, more, you know, having to switch the investor because it wasn't maybe qualified for the right investor to begin with, especially when you get into non-conforming or DPAs or complicated loans, you know, that adds up. And if you can't maintain the margin, you know, and if you're not measuring it at that discrete a level, then you really don't know. You've got leakage that's happening. You're just not really aware of where it is. I would sort of, I'll riff a bit, and David, man, you got to take over again. On the expense side, I'm once again, and I started as a loan officer. There's my caveat before I kind of jump in on the big one. 50% of the expense is in sales, and a significant portion of that expense is because we are indexed to the loan amount, which is indexed to the sales price, which is continually going up. So if, we, as an industry, when Dodd-Frank was passed and LO comp rules were passed in 2010, we were paying the average loan officer $1,800 a loan, and we're $3,000 to $4,000 plus. It is far exceeding the rate of inflation. It doesn't mean you don't deserve it, and it's not a hard job and everything else. And it's gotten, regulation makes it even harder to some cases to do this job. But at some point on the expense side, you have to attack and look at the expense in sales. And granted, it's hard to hear it, but where I consistently see this is that lenders in the Southeast, where the average loan amount is low, the average lender might do, or loan officer might do 5 to 6 loans a month. And you get out to the crazy people in California where Rob Chrisman lives, and they suddenly do 2 to 3. Why is that? Because that's all they have to if the average loan amount is 5, 6, 700,000, because we pay on basis points. So I think at some point as an industry, we need to have the fortitude to say, is paying basis points really the right way to do it? That's my challenge to management executives, and nobody wants to be the first to make these changes. But at some point, if we keep indexing to that darn loan amount, our costs are just going to keep going up. And the second part I would say about it is now for the loan officers. Let's say you're in a 100 basis point plan and you have price competition. Are you sure you want to stay in a 100 basis point plan? Are you sure that it isn't better to do one more loan a month at 70 basis points to get that additional opportunity with a realtor, to get an additional opportunity to meet a family who then becomes a referral source, to be able to be doing 4 or 5 loans a month instead of 3 or 4 loans a month, so every loan is not as big a percent of your paycheck. I mean, I never say, hey, look, you should take a pay cut. But what I'm saying is it may be better for your business to be in this tough climate, to be as sharp as possible on price and do more units. And at some point, that takes the manager and owners of companies to have the fortitude to say, I'm going to change, whether it's instituting caps or whatever. But it also means the LOs have to say, yeah, I kind of get it. Maybe I need something that's significantly different way of looking at it, even for myself. I don't know, David, what do you think?
We have a question from Tammy.
Oh, excellent. I'll read that.
Speaking of industry icons.
Yeah. What do you think will take someone to host this party? I just hosted the party, Tammy. Come on. She says, what will it take to get someone to host this party? Because we've been talking about it forever. I'm willing to host it. But you're right. Nobody wants to be the first to make a dramatic change. But here's the one issue. If you've got good producers and you're paying them 100 basis points, there's no reason you couldn't start recruiting new people into your business and not pay them 100 basis points, maybe pay them on a per unit basis. You train them, you have them come in. So you don't have to necessarily cut everybody. You can also do the approach of bringing new people in and just paying them differently. So switching, from this day forward, I'm going to do a different model. But I don't know what other ideas people might have. David, what is your thoughts?
Yeah, Garth, we talked about that one before, is about the idea of grandfathering existing comp plans, but over time, really growing a new approach and strategy through implementing something just as you described. That's one. The other one that we're hearing more and more people starting to implement is the whole concept of commission caps. And so where commission caps, were at $15,000 max, and then they went to 12, and then they went to 9,500. I'm aware of at least one client that has a max $3,500 commission cap. And so if your average loan size becomes $700,000, you're at 50 bips now. And so it is an opportunity to start ratcheting some of that down in order to be able to find the right inflection point where the increase in average ticket price, the percentage of a revenue paid out in commissions starts to become more commensurate with other sales industries. It is the white elephant in the room. It is nothing that anyone wants to talk about, but it is a challenge, and someone will solve it, and others are actively evaluating other strategies right now. The other thing that I really want to talk about while we're talking about white elephants is the whole minimum standards conversation. My friend Jeff Babcock used to bring it up every time we talk, and I'm sure he's still talking about it. But the idea that when you look at the number of people in the industry in 2020 and 2021 in terms of LOs, and then the drop off of almost 70% of unit volume in 2022, and that volume has never really recovered from that level, give or take, a few percentage points. There has been attrition, but there hasn't been 70% attrition, or there hasn't been 65% attrition. And if we were to get to that level, it would make dramatic change in the margin compression that we have right now. Because just as Gar said, you've got some people that they need to find a way to get this deal done because it's one of only two that they're going to close this month or next month. And it creates a level of sense of urgency that is obviously understandable and explainable, but it doesn't do anything to be able to, for the owners of the company to be able to make even any level of rate of return for the risk that they're taking, for the capital they have deployed against the business. And it can only last this way for so long. And so I was on a call recently with a client, 82% of their loan officers, 82%, and this was a company with over 150 loan officers that do less than $5 million annually. That's pretty significant. And so at some point,
it's a bank or credit union or IMB.
Yes, and yes, and yes. No, it isn't. It was an IMB, to be honest with you. And so you look at that and people say low producing LOs don't cost us anything. You have to be a certain number of units before you're eligible for benefits and all of those other things. But there are intangible and tangible ways that it costs you, either by brand, by reputation, by recruiting opportunities, by having to deal with difficult loans put together, all those dynamics. And so the industry has an opportunity to help people move to a different industry that are at that bottom 10% or bottom 20%. It would dramatically make an impact to our gross margins. So
yeah, they should be giving the ability to succeed elsewhere.
Yeah, that's right. Yeah. That is the message. That is the message.
I do think one of the key things, so if you sort of think back to where we started a few minutes ago when Rob issued us this challenge, and that is, if you measure productivity at the LO level, you will find the expense bleed and the revenue bleed. If you don't, you won't find it, because you'll be aggregating it too much. And we haven't even gotten to our, let's sort of pick on a vendor space now, which is the unbelievably staggering cost of credit reports.
Yeah.
So if a loan officer keeps hitting the credit button before really pre-qualifying the customer, and the lender has not really built in an effective waterfall to maybe start with a single soft pull, then go to a single pull, then do a triple, in other words, really try to manage that cost down and tie it to how likely it is that this loan is really getting anywhere, then you're just bleeding credit report costs. And granted, you can't control the cost of the credit report, but you can control how many you order.
Right. And certainly, Garth, for months now, months and months and months, I've heard about companies charging the consumer up front for a credit report, and the loan officers say, oh, we can't do that. We can't do that because we'll lose the client. Really? I mean, it continues to be a potential issue. And yeah, I mean, why not charge the borrower up front? Because obviously if that loan doesn't fund, somebody's got to pay for that credit report, and it's the company. Why not charge the borrower up front?
Well, and I think especially if you're, as part of that charge, the perception of the value from the consumer of having a meaningful discussion, including your deep credit history, if you're willing to have that conversation, is more than the cost of the credit report. But if you're just doing it to say, hey, I want to get a FICO so I can treat you like a transaction and move on to the next one, because hey, you're a 680 next. So I think if you package it as part of your counseling, and then I'll explain what's on your credit report. We'll discuss with you what the drivers of credit are. Right? Have you looked at your credit report lately? Because I think there's a lot that people can learn from it, and I'm happy to help. The cost of which is blank. That's different than before I issue a rate quote, I need you to give me your social security number and whatever amount of money so that I can pull a FICO score. I mean, that's a transactional thing, not a relationship building opportunity. So kind of how you ask for it changes the borrower's probably perception of whether they're going to pay for it.
Let me hop in here on expenses. And as Rob just said, through the vendor angle here for just a moment. If you go back and look at 2020 and 2021, every vendor that showed up on executive's door, I'm being a bit facetious, but not much, and said, oh boy, you need to sign up for this because it's going to help you. It's going to fix this, fix that. And the answer was sure. Okay, of course, we'll try it. And signed up for a lot of things. We had a customer that had 4 different POS systems and was looking at a 5th one to be able to manage at the same time, as an illustration. And so we still have clients that are managing multiple POSs. And the question that is looking today is if 2025 looks the same as 2024 and maybe 2026 looks similar, and that's your perspective, are there any tools that are like to have versus need to have? Can you find a way to streamline, standardize, and drive some level of efficiency and reduce your corporate administrative expense, reduce your training and onboarding challenges, and create efficiencies, and even through greater volume incentives, get a better deal from that one vendor versus spreading it out over 2, 3, or 4? And I suspect I'm singing to the choir on this, but it is worth repeating, because this is clearly the market of must-haves versus like-to-haves or want-to-haves, and have to take some tough decisions around that space today.
Absolutely. So I do think.
Yeah, and vendor management, David, to your point, I tell audiences, vendor management 4 or 5 years ago used to be, what can we add? What can we add? Now vendor management is, what did we add that we can now take away?
Yep.
And I will say, because we do a fair amount of work with vendors at Stratmor also. And one of the items here is in many cases, we see significant adoption of technology differences between one lender and another on the same technology. And the reason is typically process and people. So one company trained them on the value. One company designed a process that maximizes the efficiency. One company continues to measure, whether we're using this technology and how it's helping us. And they see their cost adoption go up and the costs go down overall. The other one puts it in and then says, yeah, it didn't work, so let's cut it. Well, you didn't do the people process part. So the tech was workable, but you didn't do your part to ensure you got the most value out of some of these investments that you're making. So hence you end up thinking, hey, I got to cut. And sometimes maybe cutting is the right thing, but sometimes it's maximizing the products that you're using. So I think
absolutely.
And one last comment around expense management and expense control has to do with the whole topic of productivity. For some dinosaurs here, remember the days when an underwriter used to underwrite 8 to 10 loans a day, and we realized Dodd-Frank made all of that world has changed, and some of the challenges that we do to get a loan approved and sold and purchased are very different from those days. But it doesn't mean that we have to take it lying down with 2.1 files forever. Is there a way to get to 2.5? Is there a way to get to 2.8? And does that mean that loans that are 60% or less loan to value, I could take a senior certified processor and let them validate a loan all the way through funding? Is there a way to subset underwriters based on product mix and challenge different approaches that could create some different net outcome than 2.1 files per underwriter, as an example. And by being able to take a rifle approach around productivity, not just around sales, not just around fulfillment, but every role that you meaningfully can validate productivity, post-closing, shipping, insuring, guaranteeing, et cetera. There are, as I said earlier, nickels and dimes in there that can grow to be real dollars, and productivity has got to be king.
Yeah. Yeah. And so we've actually had some pretty good comments here in the chat. Some, people commenting, hey, a high producer can actually be more expensive than a low producer or lower producer because of, all the points we already made. But I think the big item is, hey, if you don't measure it, you really don't know. And when you measure it, I think it can be pretty revealing. So Rob, did you have any other comments here before we wrap this up, other than saying, gosh, we miss Sue? So I don't know. What do you have to say, Rob? Yeah.
No, I think you've covered a lot of ground. I think it takes work. I mean, this is a job. And the glamour days of 2020, 21, 4 or 5 years in the rearview mirror now. And you can't expect, especially anyone who's come into the business since then, they have a different reality than what we were looking at 4 years ago. And it's a job. And I think that it's easy to kind of talk about it, but I know Stratmor sees time and time again where it takes work to implement these measures, and it takes discipline. And I think that's a big part of this industry now, is work and discipline. And David, before we got on, I think you were talking about how the number of we were talking about how diverse the business is or not is.
Yep.
And you were talking about how the percentage of female loan originators has increased, and I would agree with that. It seems like at conferences that portion has picked up. But I would say we're seeing people leave the industry who were the 75-year-old white male loan officer, and the people coming in are a different group. And I think that they have to get the message that it isn't some kind of glam profession, but if you're good at it and you're disciplined, especially with regard to expenses and revenue and hitting the right buttons, it can be a very, very good living. It just takes work.
Yeah, absolutely.
So, my 2 cents.
Absolutely. So I think we certainly, it appears as we enter 2025, I think it's going to be a market like 2024. And I think it'll be tough, and lenders have got to focus on a lot of little things, I think, to aggregate up to have better performance. And, I think the one thing we just keep saying over and over again is you got to be able to measure it in order to be successful. So wondering why you don't have higher revenue or wondering why your expenses are so high is not an effective strategy. You have to know exactly why and then be willing to take some actions on it. And I think that's really the key in a tight market like this.
Yep.
What gets monitored gets measured, fixed, or done. So, yep.
All right. Well, we appreciate it. Feel free to reach out to us. By the way, we are, on our Stratmor Group website. This will be posted worldwide. So it's on the World Wide Web, therefore it's worldwide. So I think they posted on YouTube, and we'll have links on LinkedIn, and you could see it, and you could pause it, you could review it, you could copy things, put it in ChatGPT and see what they think. I mean, it's incredible what you can do with all this information. But we appreciate you all showing up today, whether morning or afternoon. And thanks so much for joining us.
Thanks, everybody.
Thank you.
Thanks.